Hello friends, hello professionals, and welcome back to my channel, The Sea of Regulation. Simone here, and today's video, I'm going to be touching on something that I hope is not too controversial. It is in relation to compliance risk assessment frameworks. Is your RAF leaky? Now, risk assessment frameworks are ubiquitous with financial services. I think by now everyone gets that they need to have a risk assessment framework. But I've seen a lot of things that have gone wrong in relation to developing, implementing, and even reviewing them. But before I dive into the content, let me get my usual disclaimers out of the way. I am not a lawyer, and I'm definitely not a financial advisor. And the views on this channel are not advice. They're just my opinions and definitely do not reflect the views of any regulatory authority or international standard setting body. Now with that out of the way, let's dive in. Risk assessment frameworks. There's a lot that is required to actually get one to work. And the first point that I've seen that may result in your RAF being a bit leaky is the use of 3 tiers of risk versus 4 tiers of risk. And what does that mean? Now, I have a preference. I like even numbers because odd numbers mean that you're sitting on the fence, and that's never comfortable. You either need to be on the crest of the wave or in the trough. If you try to be on both, you tend to flip the vessel, and that's where you get leaky. Now, a 3-tier risk assessment speaks to low, medium, and high risk. But the danger that happens with financial services firms is that typically, unless you're a PEP or you're sanctioned or something else and you're clearly high risk, everyone gets lumped into medium risk. And what does medium risk mean? How do you know that someone is leaning towards a low or high risk? With a 3-tier system, it doesn't necessarily help you. And wait, I know what some of you are going to say. You're going to say, but that's why we do risk scores and apply risk weights. I'll get to that in a minute because that's another pole in the RAF. But as it relates to tiers, I personally prefer 4-tier systems. And this allows you to do a few things. It allows you to identify visually where your risk is lying. So that would be low, medium high, and high. Now, what does that mean in applying your risk? Of course, you have to go back to your compliance manual and tighten that up. Make sure that it says what you need to do in relation to each of the tiers, and it allows for you to have a bit of flexibility. So the problem with 3-tier risk systems that I find is that a lot of firms tend to miss when clients move from medium to high. With a 4-tier system, it's easier to identify. Also, as it relates to data analytics, I had some discussions in relation to that in another place, but I'll put that in the description below. If you're interested in my views on AI and data analytics, definitely some other videos from different channels that might be insightful because regulators do have views on those things. But when it comes to data analytics, how do you disaggregate medium risk clients? I have questions. How do you know when you need to be monitoring transactions more closely because there are certain patterns that are emerging with some of your clients? How do you know that you can have a more flexible approach in relation to your due diligence requirements for lower risk customers? Are you even using simplified due diligence? Those are questions that need answers. But those are some of the questions that are thrown up in my mind at least, and that I've seen come up in issues with licensees that have fallen afoul of a medium risk client that really should have been high risk. Kind of helps you hedge your bets too, eh? When you use a 3-tier system, use that 4-tier. Have your nice standard deviation in your bell curve to see where your risk lies. And then it allows you to even interrogate the data more intelligently. You see, you might be able to apply all of the tools that are available to you to see whether your risks are being generated from certain hotspots and whether those hotspots are in relation to where your clients are coming from or certain businesses that they are engaged in. There are a lot of things that you can do in relation to just a 4-tier risk system that might be a bit more messy in a 3-tier risk system. But that is just one of the areas that I've found leaks. Let me get to the next one. The next leaky bit that I've seen in RAFs is that when you do your risk assessment, some firms missed one of the risk criteria. And if you're curious about the risk criteria, I have put that in a prior video, and I'll definitely provide that in the description below. But just quickly, geographical risk, most people catch that. Client risk, most people have that. Product and service risk, some people don't really identify that as an issue, or business risk. So there are some gaps that happen sometimes in not catching the whole picture of the risk profile and just cherry picking what you want to apply. And that doesn't necessarily work for regulators. So it may be something that you need to revisit to make sure you don't have a leaky RAF. Those C's can be rough. Another issue that I've seen is the use of risk scores and risk aggregation and risk weights. And I've seen it done wrong. I've seen it done without rationale. I've seen explanations that don't really explain much. You see, when you look at certain different risks, say you have all of them right, and you're weighing the risk of geography higher than the risk of the product and the service, especially when there are typology reports that set out the issues of risks in relation to a particular industry or product or service, it kind of smacks as disingenuous to the regulator. And so what we see is that people are, I don't want to use the word manipulation because that would infer some sort of nefarious intent. Let's just say an absence of detailed thought to how to apply risk assessments and risk assessment scores. Is your geographical risk really a concern? Let's think about that. In some jurisdictions, it's easier to have a higher weight than others, and you can have stop gaps in relation to your risk weighting. So for example, if you have some sort of business or exposure or client that is in a sanctioned country, then you should have some sort of stop gap that prevents you from risk assessing the aggregate picture of that client and the geography and the product and the service. You should have a stop gap that prevents you from rating that low or the troublesome medium risk. You should have a certain floor for your risk assessment in certain cases and when your risk scoring might not be applicable, because just speaking about the issues and going through them tends to help people address their minds to how to apply risk. And you don't want that to be at the point of an inspection with your regulator. You just don't. So that is definitely one of the areas that you should check to make sure that you don't have a leaky RAF. The next area that I've seen where RAFs may be leaky is where and when you apply them. So say you have it worked out. You have a 4-tier system, good for you, not advised, but I think they work better. You have all the risks covered, you know how to risk score and risk weight and aggregate your risk scoring, but then you have the misfortune of only applying it at the point of account opening or establishing a relationship with the client. You see, that risk assessment shouldn't be just a snapshot in time. It should happen at periodic points in time. Think of when you're taking a long journey and you've plugged in the location of your destination in the GPS. The GPS will give you updates as to how you're going on your journey. And of course, you can disable it if everything is going smooth, the highway's free and clear, there's no traffic, this is a straight road, there are no exits, but all of a sudden there's an issue that's up ahead and it alerts you to that. You need to be applying your risk assessment periodically. And the technology is now becoming very much available where that could almost be a live assessment. Now, I don't recommend that at all. This is a business decision for everyone to make. And I think that there's a lot that could be learned in terms of algorithms and how to apply them in relation to risk assessments and risk scoring, but that's a different discussion. So when you apply them, people often get caught out in terms of applying or not applying their risk assessment framework after a relationship has ended. You see, when things are good, the relationship is great, it's the honeymoon period, you're not worried about that person being a terrorist or a money launderer or engaged in some other financial crime or other illegal activity. but then the relationship sours, you've not done a risk assessment, the relationship lasted for 1, 2, 3 years, and you've not done an incremental risk assessment even on one transaction. That could be a problem. And you don't want that to be discovered by law enforcement authorities who are investigating those illegal activities, or by your regulator, because here's a little tip: regulators are going to be inspecting records of companies that are no longer active as well. That's a free tip. Don't tell them I told you. But it's important to have incremental risk assessments being done in relation to your client base. So make sure you don't have a leaky RAF and carry out that risk assessment at least at some sort of regular interval. It helps. The next issue that I've seen in relation to risk assessment frameworks is that they don't evolve well in the face of updating typologies. And what does that mean? Now, FATF, I speak about them a lot. Again, I've done videos in relation to international standard setters. I'll link them in the description below to make sure that you're aware of who they are if you're not by now, because I do understand that some of the viewers may just be compliance curious, and that is okay. Now, as it relates to risk assessment frameworks, you need to update those periodically to reflect changes in typologies. And what are typologies? Well, trends, analyses, reports, a lot of different findings, how businesses evolve, all amalgamated into a report that sets out some of the risks that are inherent to businesses. And I've mentioned this on the channel before. If we had to look at a particular risk to banking, theft of money, how people stole money from a bank is considerably different in 2021 than it was in 1921. And so that's definitely a change in typology. And all of the things that have evolved in relation to keeping money safe and assets safe and people safe in relation to banking and their money has evolved over time because of studies and analyses and trends that are amalgamated into typology reports. FATF focuses on AML-CFT issues, but of course, there are other publications that should be considered in relation to your sector. I personally like the Bank of International Settlement as it relates to certain banking and cross-border issues. I'll definitely put their link in the description below so you can do some of your own reading. The last point that I'm going to look at is in relation to your RAF and how you actually apply it. You see, regulators do read these things. And then when we go in and inspect and we ask questions, we see the divide between what is written and what is done about as wide as the Grand Canyon. And that is not a good thing. Part of it may be that the people who are applying it, and it's not the compliance officers that are typically applying it, the people who are applying it don't necessarily understand how to apply it. And so the compliance officer may have done training, they may have done testing, and people pass the test, but when rubber hits road, you realize that you have on the wrong treads to off-road. In fact, you can't even drive because this is a manual and you only know how to drive automatic. So, just a little analogy in terms of the auto mechanics, but in relation to actual applied risk assessment frameworks, I have seen that being an area that causes issues too. And if you can think of some other areas where your RAF may be leaky, I can think on 1 or 2 more, and I'm leaving that for my membership. I'll put information in relation to my compliance professionals membership in the description below. But if you can think of some other examples, you know what to do. Drop it in the description. Let's have a discussion. Or better yet, join the membership. There's going to be a lot of content that's not necessarily on YouTube, but I'm going to keep these videos regular. And to do that, I need you to help me out. I need you to do the YouTube things. I need you to hit like, definitely hit like. Share it with your friends, because sharing is caring, and subscribe if you haven't. And for everyone who has subscribed thus far, a huge thank you. I'm still seeing the numbers going up, and I'm thrilled about that. Until my next video, guys, I am going to work on some different content in relation to enterprise risk management. And if there are any topics that you're interested in, you know what to do. Once again, drop it in the comments below. I definitely want to hear from you. But until the next one, guys, I'm going to wrap it up here, and I'll see you on my next video.